first and foremost, thank you to our great friends at Jenner & Block. I have the unique privilege, the distinct privilege of working with Jeremy on a number of items, and it is truly a pleasure to work with you and the entire team at Jenner all the time. Laurel, I wish I got to work with you more, but I'm looking forward to that as we continue to progress. Welcome to the Future of Finance webinar series. It's funny as we think about financial services, and when we came up with the title and the subject matter for today's panel, with the title of Uncharted Waters, I'm not quite certain, it would have felt more, appropriate given everything going on. But obviously, my guess is all of you are going to have somewhat different answers today than you probably would have thought you may have had a week ago or the week before as we thought through this, the topic and the panel. Again, thank you all for your continued contributions to the American Fintech Council. Excited to have a great panel of experts here to talk through embedded finance, fintech partner in an era of increased regulation, at least for now. We'll see how things continue to play out. And more importantly, thank you to our members for your continued collaboration, expertise, willingness to participate in panels just like this one, so we can ensure best practice as we continue to grow the fintech ecosystem. So with that, Jeremy, I will kick it off to you.
Great. Thank you so much, Phil. And I just want to say a quick thank you to the American Fintech Council and to Phil, of course, and Taylor and the rest of your team. We enjoy so much working with you and feel so privileged and honored to participate today and in all the activities we do with the council. It's really an extraordinary resource for the industry, and particularly right now, post-election, I think these resources are really incredibly helpful to figure out where we're going or not going. So let me begin just with a few introductions of the great panelists we have and my colleague Laurel. So let me begin with Meghan Ryan on our panel. Meghan has had a tremendous career in financial services. She's the CFO currently of MANTL, which is a modern banking software platform. And she spent the last 7 years in the fintech space more broadly. She joined MANTL from Treasury Prime. You may know it as a BaaS provider, where she also held the CFO position. And she was drawn to the bank software space following her time at a firm where she was responsible for a bunch of different areas, for capital markets, for bank partnerships. And in her last role, she was the CFO of a firm's Canadian business. Before that, she spent the first half of her career at Deloitte and Goldman Sachs in a number of different roles in consulting, advisory, and investing roles. So she really has covered the landscape. So welcome, Meghan. Next, we have Andrew Stines from Coastal Community Bank. And Andrew, he joined Coastal in 2020, and he currently serves as Chief Risk Officer of both Coastal Community Bank and the Coastal Financial Corporation. And he oversees the Enterprise Risk Management Department, financial crimes compliance teams, consumer compliance teams, including CRA, and various other administration teams. He's also a subject matter expert in financial institution compliance more generally, risk and governance-related matters. Before joining Coastal, he was the Executive Director of Financial Services Risk Management for Ernst & Young, Chief Risk Officer at SunWest Bank, and manager of the financial services regulatory practice for PricewaterhouseCoopers. And before that, he was an associate at Dorsey & Whitney. So he's a fellow lawyer. He also, I think, is involved in motocross, but I doubt we'll have time to get into that area. But that's for a different webinar, different trade association. And finally, we have Steve Bishop, who joined Old Missouri Bank or OMB Bank in 2020 and leads its fintech-related strategic growth initiatives as Chief Innovation Officer and President of OMBX, the bank's dedicated embedded finance division. Before OMB, Steve had 2 separate stints at Jack Henry & Associates, most recently as Director of Client Services. And in addition, between those roles, he worked for AT&T as a Senior Financial Analyst, and for Citibank as a VP of Offshore Management. So those are our great panelists. Finally, last but not least, I'll introduce my partner, Laurel. Laurel has had just a really tremendous career in financial services as an attorney. both at DOJ doing some of the earliest, most innovative work in enforcement in crypto and in fintech, and then moved over to the CFPB where she was deputy in enforcement, and then after a number of other roles in government, has been in private practice, and with me and others at Jenner, we do a lot of regulatory investigations, enforcement, compliance work, and litigation related to both fintech and crypto. So with that, I'm going to turn it over to Laurel.
Thanks, Jeremy. I think you didn't get a chance to give your full bio, which has a few interesting points. Anything you want to share with the group?
We'll get to that when we get to the motocross. So,
all right. Okay. That we'll have plenty of time. All right. Well, thanks to everyone for joining us. As we've alluded to, it's been a slow news week. And with that, I think we should start just to try to level set a little bit. We're going to talk about a number of topics here. Probably we'll touch on this throughout our discussion, but I want to start and ask everyone here, and I'm going to, and I and Jeremy will kick it off with a couple thoughts of our own and then pass to the panelists, but what we think the impact of the election results will be on this sector of, fintech bank partnerships. And I'll start just with, because I am a former CFPBer, I worked there in the early days. We've obviously been through a Trump administration before. A couple observations. One of the things that surprised me, frankly, was how much of the staff remained through that time period before, and I expect will remain again. I have many friends there who I worked with in the early days and are still there and will stay there as long as they can. There's a variety of reasons for that, but it's an interesting factor that does play in. Obviously, there's going to be a change in director. There's going to be an effort to roll back some of the policies, the rules, and some of the guidance that has been issued, and we expect to see some rule changes. But on the enforcement front, where I spend most of my time, we still expect to see enforcement. At least that's what we saw last time. The targets may be a little bit different, maybe not so much sort of the idea of recidivist, large legacy financial institutions, but maybe a little bit more of, what might be kind of considered traditional consumer protection. So I don't think we'll see it go away, but there certainly will be a change. With that, Jeremy, you want to offer some thoughts, and then we can pass to our panelists.
Sure. I'm gonna say something somewhat provocative, but I think, let me suggest that I think actually we're going to enter a sort of golden era of bank fintech partnerships for a couple of reasons, three reasons. And it may be a matter of emphasis. We may disagree a little bit on this, but first, we all know that in the last over the last 4 years, there's been an increase in regulatory scrutiny, and both by the prudential regulators in their focus and supervision on the nitty-gritty of bank fintech partnerships, the documentation, the compliance, all of that. We all are very familiar with that, and in enforcement and in different proposed, at least, rulemakings. And I think one undeniable impact of that has been a winnowing of fintechs, a winnowing of those partnerships, and probably at least to some degree a helpful refinement and strengthening of the sector to weed out those that are less able to withstand scrutiny and less prepared to really invest in what is necessary to succeed. So that's one factor. And I think that even though it's been painful, I think there's a sort of a benefit in terms of knowing what the roadmap is for addressing a lot of the regulatory concerns and operational concerns. So the second thing is sort of, given that now we will be in a new administration, and I think there really is going to be an enormous deregulatory pressure at the federal level. We already are seeing, of course, even before the change in administration, a lot of pressure on the agencies in courts, challenges to the proposed rules that the CFPB has proposed, BNPL, the credit card late fee rule, and through comments, at least so far, the earned wage access rule. and a lot of the efforts by CFPB and other agencies to really clamp down. We've seen a lot of pushback, and courts, will only, I think, get more assertive in pushing back against agency efforts there. I think that will only increase, and that's not just because of new appointments. I think that's just going to be the vibe that's going to affect the courts. And then at the agency level, I think we really, and in Congress, especially if the Republicans take both the Senate and the House, I think we're going to see substantial reduction in regulatory scrutiny and proposed rules. Also, and Congress may very well take action. I mean, there are, as we all know, there are bills that have been proposed to push back on examinations. There was even a proposal to create an Office of Independent Examination Review to sort of where financial institutions could challenge examinations. I think we may see a lot of congressional activity there to shift that balance. The last factor I just would note is technology. I think we're going to see technology, the explosion in innovation in technology only increase to solve for a lot of the regulatory problems and compliance challenges and costs that have been increased because of the regulatory scrutiny. And my hope is that the technology is going to not only provide solutions, but also less costly solutions for a lot of these regulatory challenges, so that we're going to see, even if the regulatory scrutiny goes down, we're going to see technology pick up some of the slack and make it easier to comply. So with that, I'm actually hopeful for the sector and for these partnerships.
Jeremy, turns out you're an optimist. This is good to know. With that, Steve.
In this area, yeah.
Steve, do you want to start with your thoughts? Maybe, I mean, Jeremy set the table here. I mean, how do you even think about planning and going forward at this stage, as you're sort of thinking about what may change?
Yeah, I mean, it's very interesting. And first of all, thank you, Laurel and Jeremy, for moderating this. You guys have the tough job, because you have to direct the dialogue and come up with questions, and the rest of us just get to sit back and talk. So thank you. Thank you, AFC, for the invitation as well. I think for me, I have a slightly different take. I think, I'm hopeful that whether it's the election or not, but the change in it, just like Jeremy talked about, the tech is going to change. Our industry is going to change. And the biggest challenge that I've seen is the examiners are using regulations that are decades old to try to and fit the new model into it, and it just doesn't work. And so it makes it very hard to plan, because you have how are they going to take this brand new, specifically embedded finance is what I think of, and how are they going to fit that into these old regulations, and how do I comply with that? And they introduced the novel activities board, but then they can't tell you what the rules are. And if you don't know the rules, it's really hard to plan accordingly. And so, I think, I agree with you, Laurel. I think CFPB will probably have some changes. Might see, they're not going to take the same path of actions that they would have otherwise. But really, I think I'm mostly just hopeful that we see the examiners evolve with the industry and with the pace, because we're in a very exciting time for the financial services, because it is evolving. It's going to be amazing next few years to see where it goes and how it plays out. But we also have to make sure that all parts of it keep up with it and are moving forward in the same direction.
Yeah, thanks very much, Steve. Andy, you want to jump in now? Your thoughts?
Sure. And I echo Steve. Thank you, Jeremy, Laurel, for having me here. Thanks to the AFC. It's been a great time. Yeah, I don't see really any change from my perspective in the short term. I am hopeful that some of the scrutiny relaxes over the next, over the course of this administration. I don't see any change over the next 12 months per se. I think we have our tasks and remediation efforts to complete, and we're working closely with our examiners. I don't see a lot of change. BSA is obviously a continued big focus of the examiners. I haven't in all my career seen that ever change between administrations. So I don't anticipate a big change there. I'm with you, Steve. This novel banking group, we have novel examiners that are assigned to our bank, and they come in and they offer some good advice and ask some good questions around things that they've seen at other institutions. But I have no rules to follow. I don't know what the game plan is. So we do our best and hope for the best each time. But yeah, I think on the consumer compliance side, I have traditionally seen that relax under a Republican administration. So I am interested to see what comes of that. I don't have a crystal ball. I was sharing with my colleagues here earlier this morning via email. I said I'm not really sure, but I anticipate some relaxation in that space. I did want to mention one thing right before this webinar. An article popped up on my computer from Banking Dive. It was yesterday, and so I'm just 6 regulatory moves, people whose days are numbered under Trump. If anybody's interested, you might want to check that out. I found it to be somewhat interesting. Thanks.
Yeah, that's great. Hard to keep current and everything that's coming day by day today. But and Megan, you're in a little bit of a different position, not inside a bank. What's your point of view on this?
Yeah, absolutely. And first, of course, I want to echo thanks to both the AFC and Laurel and Jeremy for having us and moderating today. Really appreciate the opportunity to speak with everyone. Obviously, I come from a slightly different perspective, not being within a bank and kind of feeling the regulations firsthand. The things that I think about, you look back to the first Trump presidency, and of course, he did have a deregulatory mindset. And then we've since seen the enforcement actions in particular increase over the last several years. And the two things that I think have really changed or have impacted the mindset in a meaningful way are both FTX and Synapse. And I'm very interested to see how, continuing to respond to the challenges that we're faced with both of those situations impacts the next Trump regime in terms of how they think about approaching fintech and bank partnerships more broadly. But I am hopeful that they will provide more clarity. It makes things easier for all of us. And I'm with Jeremy in that I really am excited for an opportunity for fintech and banks to work together in a productive way.
Thanks, Megan. So you mentioned Synapse, and that's a little farther down my list of questions, but I think we should just start with the now, because it's also maybe another elephant in the room, and I think it's potentially interesting given the sort of deregulatory approach and then the increased concern and scrutiny by regulators that came out of that event. But what are your thoughts? And I'll ask Andy and Steve to weigh in also on how that the Synapse occurrence has impacted regulatory expectations or just interactions with regulators in recent weeks and months.
Sure, I think it really brought to light the relationship or really lack thereof between the fintechs and their bank partner. The fact that Synapse was sitting in between and was really acting as that middleman and not making it very clear for the fintech and for the bank what the respective expectations were of each party created a lot of the challenges that we face today. And so, what we've seen since then is that there's increased focus on having direct relationships between the banks and their fintechs, having a very clear dialogue and clear expectations around who owns each piece of the customer relationship, the compliance obligations, the oversight, and so forth. And I think that's really healthy. I think that is, where we ultimately expected the industry to go. But the Synapse situation, I think, really kind of expedited the urgency around ensuring that there was very, very clear alignment between banks and their fintechs, so that everyone can be operating with the same playbook.
Right. So, I mean, so Andy, how does that affect your day to day? What happened with Synapse, and how you think about, is that maybe too much for our time left? But
No. You're right. I could go on for a long while. I'll try to be brief. The Evolve and Synapse issues have definitely affected us. We recently had a safety and soundness exam where a lot of the questions and emphasis were on areas similar to what we see in the order for Evolve. Yeah, and the one point I wanted to make is we currently and don't have any plans to use a middleware. So we consider our customers as if we consider our fintech partners as if it's a branch. I mean, literally, their customers are really just our customers, and so we just have a direct line of sight into this. So, but yeah, going back to what's the effect, you can see the spillover. I've had examiners come out and say they're scared. That's a big statement. When they're scared, that's not a good thing. It's not good for any of us.
And what are they scared of? I mean, I have my ideas on this, but what's your sense of it?
I think they're scared of what they don't know. When they come in as an examiner and they come in periodically and they try to understand the complexities of our institution and our relationships, I think they're very scared of what they don't see. What don't they understand that they could be missing and that could blow up after they leave the exam and then come back to them. I think that's broadly, but I'm interested to hear what your thoughts are on that. Oh, Laurel, sorry.
Yeah, no, consistent, I think. I mean, nobody wants to be the regulator that missed something. And I think to Steve's point earlier, there's a huge learning curve, and there was before this. And I mean, there's a lot of great examiners, and the job they do is hard, and a lot of them build really great relationships with the folks that they examine, but they don't generally come from the same sort of mindset or background as these sort of innovative financial services companies that they're working with. And so I can imagine that the fear comes from both things, exactly as you said, that they don't really know that they're asking the right questions, and that they're going to get, there's going to be some big blowback if they miss it. Yeah. And Steve, what about you with the Evolve Synapse situation?
It's the most entertaining thing that's happened this year. It's like a tabloid soap opera. I mean,
it's a broad use of the word entertaining.
Like, you wouldn't believe it's actually happening if it didn't. It's just a crazy scenario, and I think it's a shining example of how not to do banking as a service. And it provides a playbook for just how not to operate. It has for me, it actually created some opportunity because I have a good relationship with my examiners, and there was another agency that had some banks shut down their programs, not because of anything they did, but it created opportunity for me to bring on fintechs to my platform. And so, it's not trying to take advantage of a bad situation, but it was I was helping that fintech stay in business, right, and move forward. So, it's insane the things that we read and see happen in that situation. It's a shame. I have concerns that there'll be overreaction because there was consumer impact, and it's if you have a situation where the delta of missing money is in the tens of millions, they can't even define it closer than that. It's just how does that even happen? And it's just a reminder that as bankers, our job is we balance, we stay in compliance, and why the hell would you ever commingle an FBO? For us, we have multiple FBOs for fintechs that more often than we have we're definitely never commingling. It's a minimum of one, and oftentimes more. And so, there is the twisted side of me that reads it. I'm like, wow, that's pretty crazy. But we, as an industry, we need to learn from it and move forward. And like this, it's something that should never happen and absolutely should never happen again.
And maybe to that point, we'll bring it to a little bit more of a practical question, which is, in pursuing the compliance necessary to avoid, I mean, obviously that's an extreme example, but what are some of the challenges? And Andy, I'll start with you, whether it's in terms of costs or data management or other things. What are the primary things that are sort of keeping you up at night when you're thinking about your compliance needs?
Well, you just hit the two big ones. It's cost and data, right? Look, the cost of compliance and meeting the expectations of the examiners is higher than I could ever imagine right now, especially for a community bank. Luckily, I have a very strong board, strong executive team that supports investment and growth ahead of time, which was why we've continued to be successful. But right now, I think that the compliance costs are putting a lot of pressure on the business model. And that's, when I talk to new financial institutions that want to come into this space, we spend a lot of time talking about the costs. And I recommend to them to, be upfront with their fintechs before they enter the relationship that they're going to have to share these costs, because they've just become so onerous.
What are the primary drivers of the costs that you're thinking of?
Primary drivers are really, for us, it's mostly financial crimes compliance, to be honest with you. I'd say that's our biggest cost driver. When I started with this bank 5 years ago, almost 5 years ago, there were 7 of us in the entire risk group. Today, we're over 100 in the risk group. Most of that is financial crimes compliance, and that doesn't include the 60+ offshore folks that I have helping with investigations. It's a huge cost, not to mention these transaction monitoring systems that have to be, we're monitoring 75 million transactions a month. I mean, that we're getting to the scale of a mid to large size regional bank with community bank resources. So it's an everyday topic for me. Yeah, it's tough. That's what's driving most of the cost.
Yeah, and I'll just a little comment on that point. As a person who deals with a lot of enforcement actions, the number one thing I see in every single one is staffing. So I can understand why that's painful. It's also why it's so critical. And it's always an argument that that there was understaffed, improperly staffed, lack of qualified staff, whatever it is.
And that leads me into something else right there. And I meant to talk about staffing as well. Not just the number of people, but the expertise and the caliber of the type of people that I need to hire to get us to the next phase is very, very expensive. Trying to get that, what I call big bank experience in here, is not cheap. And so, yeah, that's a big cost driver for us.
Yeah.
Go
ahead.
Well, I was just going to ask a kind of a follow-up. I'm interested in, one of the things that I'm always interested in is the way in which, although there are obviously great efficiencies involved in fintech partnerships, this is one area where there strikes me that there are often inefficiencies in that both the fintech, especially now that there's more focus on, scrutiny on the fintechs and their partner banks for the same things at the same time, that there's some redundancy there in terms of, who's handling this due diligence and these checks. And sometimes part of the issue is who's doing what, right? Figuring out that, and that's not always clear. But the other piece is, even if it's clear, both entities are often doing it, and it's incurring costs, and it's the expectations have only in recent years have only increased in both verticals. So one of my fantasies is that in the next chapter, as technology is used and as we figure out how to divide these, the roles more clearly in a more standardized way, there'll be less redundancy. So I'm interested just in the question of redundancy with fintech, between the fintech and the bank, and your experience with that issue.
Yeah, so interesting timing of the question, because for the last 6 months, I've been working with each of my partners in looking at redundancies. So I'm going to use financial crimes compliance as an example, because that's where the heaviest cost is. So that made sense to prioritize there. We take the approach that, well, and this is partly driven by the examiners. The examiners don't care about what the fintech's doing. That's just a branch. What are we doing as the financial institution? So I own most of it. So I'm making sure as I go back out and rethink our program agreements from 3-5 years ago, what did we ask you to do then? What have we learned? Oh, guess what? You don't need to do all of that. So the big push now is, if I can tell you to stop doing EDD, enhanced due diligence, for example, because I do it in-house. I run my own customer risk scoring methodology. If you don't do that, I can save you money there, and then you help pay us to do it. And we'll spread that cost, across the different partners. That's what's changing right now. And we're really pushing for this.
I mean, to me, it seems like there's a lot of room for that kind of conversation to happen.
There is
a lot of cost saved. So hopefully that will be one source of, cost reduction, or at least efficiency.
I had a call with a fintech this morning about this very thing, and promised that I'd get on the road and meet with them, and we'd walk through all the processes that they do, all of our processes, and see where we're duplicative and get rid of those.
The lawyer in me can't help but just say one thing about that, which I think is a great thing to do and a great way to look at cost savings. But many folks are challenged by doing reliance well, especially under some of the legal requirements that are there, particularly under the BSA, for where you can formally rely on others, where both entities are licensed or have a AML requirement. And so just keep that in mind. I'm sure you are, but for others, just keep that in mind. Meghan, as a technology solutions company, maybe you have a perspective on where technology can, how the sort of growth trajectory of technology solutions are also helping in some of these compliance requirements.
Yeah, absolutely. So I think we're seeing a few different things happening right now. We're seeing compliance-specific technology providers cropping up that are really going after specific challenges. There's everything from the KYC, KYB landscape, the transaction monitoring landscape, the oversight system, so that when your regulators come in, they know everything that you've done for every step of the customer relationship and can more easily provide the data necessary for those regulatory exams. And I think this is all a fantastic starting point to help bring down the cost of complying over time. The more that we can provide the right both access to data and tooling to make that data really usable, I think that will have a great impact and hopefully help with Andy's problem of always having to hire more people. If you can make each of those people more efficient because you're saving them time in terms of automating things that were previously done manually, giving them easier access to the things that they know they're going to need on an ongoing basis, whether in their day-to-day work or during an exam, or spot areas where previously it's been very difficult to gather that data. Making sure that we're filling those gaps and finding ways to just make the banks more efficient. That is a huge area of focus, and I think at MANTL it's something that we spend a lot of time thinking about. And pride ourselves on ensuring that we're saving man hours in the banks themselves. And then just making sure that the banks also feel very comfortable with the way that we're operating and have the right data security and all of the appropriate things such that we're a reliable partner for them.
Yeah, and so as we're thinking about those types of solutions to implement some of these compliance challenges, Steve, I want to swing back to you and ask, as you're thinking about those sorts of things and working out these ways to meet requirements, how do you deal with multiple regulators, who may be talking to you at the same time and maybe have different expectations or different levels of understanding? How does that come up and how do you handle that?
I mean, we have our primary examiner, and that's who we work with mostly. And yeah, I started very early on, about when I first started looking at BAS, knowing I wanted to do it. It was all about building that relationship and meeting with them on a consistent basis. And I have a strong relationship, I feel, with them because I've been very open, and like the what I've preached is we're going to lead with compliance. That's our goal. And historically, our bank has always been understaffed. That's examiners are like, you had more staff all the time, and it's something I consistently am talking about with the board, the other execs, that we have to staff up. And but the beauty of it, though, is we create excitement about, we have a separate brand now. This is the future of the bank, and so we see a lot higher internal candidates that are wanting to be a part of this and a part of the future. And so the talent pool, it's, as Andy said, it's hard to find experience and bring it in. So you have to train it up or pay up. Banks have to change their mindset to be more like a tech company. You can't pay bank rates, you have to pay tech rates. But it's a better business line to be in, at least in my view, than your traditional brick and mortar checking account. So you have those opportunities, and from a tech standpoint, I've got a couple of solutions that kind of overlap, because I want to test them out and see which one evolves faster. And I'm okay with that extra expense because I know in the long run, I'm gonna have a more efficient tech stack and have the best in class. And it's also having those partnerships with those companies, those startups. RegTech is so hot right now. If you get an early entry, if you're one of their first logos, they're going to design their product around your needs and take that to market. So there's benefit there. And then to actually get back to your question on preparing for examiners, leveraging that RegTech, you have a repository of, this is the stuff the examiner wants to see. And so whoever it is that's asking, I have a place that I can point them and show them, this is our process, these are the artifacts we have, and prove out. Because we all know if it's not written down, it never happened.
That is a good lesson.
Can I follow up on that, Laurel? Just, I'm interested in how much to your point about the RegTechs building, sort of bespoke solutions for, I mean, obviously one of the things that I think we hear a lot is that the regulators are really playing catch up on the technology, and that's only going to get worse with the use of AI, more broadly. How much is that a barrier, and where do you see that going in terms of, the diversity of the tech solutions, the complexity of them, and how you, and the learning curve for regulators?
So for I have a suspicion, because our examiners are coming in to do an unofficial visit, just to kick the tires before they come in for real one. That engagement's going to be twice as long as I expected, and have twice as many examiners as I expected. And I think they want to learn. We have done cannabis banking in the past, and the same examiner they came and learned from or with us. I mean, it was like a partnership there. And there's a lot of commonalities between cannabis banking and your banking as a service in a compliant sort of viewpoint. And so I think the regulators need to partner with the banks as much as they're doing it to learn. So they know their customers. There's less than 10% of banks are doing this or even looking at it, from what I've seen. So there are going to be innovators out there that can help, and the examiners are going to know about it. And if they have that partnership, like, if you don't treat this as your enemies working against each other, but working together, you can learn together and stay cutting edge. And I'm not a traditional community banker. I worked for Jack Henry in the tech side for most of my career. And so I'm able to navigate that line between technology and super slow banking people. But it's a fine line, and I've built a team along that, so we can talk to tech companies that want to move fast and break stuff, and banks that want to be the last to change. And like, if you can find that blend and you can take that and work with your examiners and build those relationships, like you can all come up that learning curve, not necessarily together, but very closely aligned. And knowing that the change of the pace of change just can be growing even faster. It's more important, like today is the day to have those relationships and keep building, because it's only gonna get harder to do it as we progress down that timeline.
Yeah, makes sense. I wanted to go back. I think, Andy, we mentioned data management at one point, but I'm not sure we went into it too much. And I think it's probably important enough to make sure we cover that. And I guess I'd just love to get your sense of what some of the biggest challenges are and how any success stories you've had in managing those in the bank fintech partnership model.
Yeah, it's I have to start off with saying one thing. If I were to sit down as a panelist in the future and somebody asks, what's the one thing that surprised you with getting into banking as a service? When I came from a regular financial institution and was going to be dealing with fintechs, I said, great, finally, somebody who knows how to deal with data. I'm not going to have the data problems that I saw. Wrong. The data has been a real challenge. It's not that the fintechs don't have it. It's that they have it from multiple sources and they have to get it into a format and over to us. And if you don't have those pipes built, you're back to sharing on SFTP folders. And I'm not a tech person, so forgive me if I misuse some terms here, but trying to get those data points over to us and getting us and finding a way for us to use them has been an ongoing challenge. Success stories, we recognized as a growth bank that we were going to be a high volume transaction shop. So we had to solve for it. So the board and our leadership doubled down and made the decision to invest heavily into data governance, data infrastructure. We've built a wonderful lake house. We're working with our partners now on moving them towards Delta sharing. So you're not, you want to move data less, but you want to give them access, have people be able to come in and have access to this data instead of trying to move it all around. So we are moving in the right direction. It may not be going as fast as I'd like because there just is so much involved. But yeah, you talk about the data. I mean, I still, where I can't get certain data because it takes too long, I have to do a process. Manual processes mean I can't get rid of an FTE. I have to add an FTE. My compliance costs keep going up. It's a struggle. They're intertwined.
Yeah, I, as you mentioned, manual processes, I will admit that's an area that was surprising to me. I often come in, or usually come in after the fact when there's a request for information, a subpoena or something like that. And the amount of times someone has said, let me get you that Google Doc or, Google Sheet or whatever it is with the data that they need is slightly horrifying, but definitely a challenge and better than nothing. But there is a long way to go with some of the companies that are, just building naturally. But so obviously the data behind that is not as easily accessible as well. So definitely a big area of challenge.
I mean, that may be ultimately one benefit or silver lining from the Synapse, situation, because one of the big challenges there was the data incompatibility and the difficulty of actually figuring out, it wasn't just who had the information, it was why wasn't it, in the right places. And part of the reason was the format issues that were, so one would hope that over time that there's a standardization of that would reduce costs and also, get everyone on the same page as to what is required when you're talking about these partnerships.
And Megan, did you want to add something on that?
Yeah, I do think that what we traditionally call the banking as a service providers, when done the right way, are actually meant to solve that problem, right? They are meant to standardize the data intake to make it so that Andy's getting the same information from every one of his fintech partners in the same format. And then for the fintech, to the extent that they are working with multiple banks, they're also able to standardize how they're integrating with those banks and providing that information as well. So I do think that there is very good intent in what these banking as a service players are looking to do. I think, to Steve's earlier point, Synapse just went about it all in the wrong way. But that is a huge value add, in my opinion. From my experience being on the fintech side of things, when I was trying to integrate to multiple bank partners, it was a very long and challenging process because we had to do different things for each partner. It was not standardized, so it was very inefficient for us. It was challenging for the banks because they had to work with us to manage things that we had or didn't have that were different from their other programs and so forth. And so I really think that that's where the right banking as a service platform helps you provide that standardization and makes the overall ecosystem work better.
That makes a lot of sense. Yeah, that's a really great perspective, and is a good selling point, I would think, as you're marketing your your products.
Yeah, exactly.
Well, speaking of challenges, I want to ask, I think, Steve and Andy, whether you've had to deal with situations where you have to wind down a relationship. This is an area where I think there's been a lot more focus from regulators. I've seen some enforcement actions recently that talk about not having ended a relationship when it should have been ended. And we all know that's a hard thing to do, and it's much easier for the regulator's point of view to say that after the fact. But I'd be interested in your perspective, if you've dealt with that, how you've dealt with that, what some of the challenges are.
We have. Steve, do you want to go first, or I can?
I'll go first because you'll have a lot more to add on this topic than I do. So, I think Andy, you have much more experience here and further down the path, many more programs. I've not had a fintech that we had to in that relationship with. I have had other relationships, and it's going to be this similar. Like, I'm providing a service to them. They still need to. They have customers. Like, they're going to be negatively impacted. So how do you balance that? Doing what you need to from a regulatory standpoint, but still not just totally leaving your customer in the lurch. That can be tough to navigate. I have a couple of fintechs I alluded to earlier that were onboarding that for the last month they haven't been able to add new accounts because the examiner said you don't have to offload everyone right now, but you can't open them. And so these two founders, like, I'm on the phone with them, and they're just scared because what they've built over the past few years, and they've had this success, no longer are they able to operate and add to it. And so there's impact. And this was not from something that was wrong with the program. It was just examiners not wanting, like, there was something else going on there, unrelated. And so these are good fintechs unable to continue operating. And so that's, I'll let Andy actually add value, but like I can talk about how hard and complex it is. And so it's definitely something to keep in mind.
Yeah, I thanks, Steve. I don't know how much value I can add, but we have wound down 9 partners so far successfully for multiple reasons. We got relatively lucky on our first one because we were on good terms with them. They just didn't have a very successful business model, and we had a long timeline. And so we ended up using that experience to build a wind down program. And we did that with the focus being no consumer harm, right? Making sure that they have access to their funds. If you build around that first and think about those priorities first, the rest kind of falls into place. And so, yeah, having this wind down plan has been instrumental. We also do tabletop exercises. So it's almost like continuity business planning, right? But we say, if this one goes south, what do we do? And we'll run through the scenarios and kind of keep ourselves up to speed and practiced, so to speak, on how to do this. But you know, we have very close relationships with our partners. We know where they're at from a cash perspective. We know what their volumes are, where their projections are. Are they meeting projections? Are things going south? Are they not hitting where they need to be? So we're interacting with them almost daily. So we kind of know ahead of time when we think something's not going to work, and so we end up getting ahead of it. We're not surprised. Neither the fintech's not surprised. We're not surprised. And so we've been lucky there, I think.
Well, that sounds like some in the trenches experience.
Yeah.
Actually, not easy. Okay, I think, given where we are, I'm going to move to asking everybody for some, one or two key takeaways given the environment. Factor in the new, administration coming in, your experience thus far, whatever you can fit in. I'm going to offer something. I'm going to go to Jeremy and then move through the panel. And I'm going to mention something, and I mentioned it during our prep session and didn't get any real excited looks, but it is one of my takeaways, and that is something we haven't discussed today, but is the idea of a customized risk assessment. The reason that I mentioned that, we've been talking about some of the novel, the focus on novel business models that the regulators have. And again, in my role as an enforcement attorney, I find that to be one of the most significant defensive pieces of work, particularly in the context where regulators have now been calling for much more customized relationship by relationship risk assessments. And so I don't know that that's necessarily standard throughout the industry at this point, but I leave that as my takeaway of something to sort of think about how it can be useful in those relationship with regulators and in sort of defensibility of the relationships that we have. And then I'll pass to Jeremy to see if you have any takeaways you want to offer.
I'm going to turn it over to our panelists first.
All right, Megan, you want to start?
Sure. One of the things that I've thought a lot about in recent times is how we continue to help fintech in light of all of the challenges that have been faced over the last year or so. Because I ultimately think it is very good for the entire ecosystem. And whether that's through building better technology and tooling to enable it, or through also facilitating the right types of relationships between fintechs and banks, like there's so much opportunity. And I think the barrier to entry to get into fintech has been raised substantially because you have to show up at a bank with the right preparation, with the right understanding of the risk that you're entering into, and the right buy-in to build the systems and have the right in-house expertise to be a good partner to that bank. So I think we're going to see a lot of that play out in the short term here, but I am also just very optimistic that we will continue to see really healthy relationships between banks and fintechs as the dust settles from Synapse, and hopefully we get that regulatory clarity that we're all seeking.
We can dream, right? But those are really great.
Right.
Thanks. Steve, you want to go next?
Sure. I'll keep it simple because I'm a simple person. Like everything in life, or at least most everything, it comes down to relationships. And what I love about this space is it's not a zero-sum game, that we can all win together. Like the fintech success can match my success. It's not a I win, they win. I lose, they win. And that comes down to the relationships. And the same thing with your examiners. You have that relationship. And I always talk about when I'm exploring a new partnership with the fintech, that like we'll go through the MSA and talk about these terms, but at the end of the day, I have to want to work with you. You have to want to work with me. We don't ever want to look at that contract. We know we're going to hit bumps in the road. We need to have the relationship that we can figure out how to do it. With examiners, we have to figure out how to do it as well. This is the future of banking. That's the other thing, takeaway. I think there has to be a way to do it. This is the future of banking. The analogy I use probably too often. When I was growing up, we had a map. We fold it out. Your black dot, you move around the world on that map. And now you have your phone and your blue dot, and the world moves around you. So traditional banking is the brick and mortar. They're the black dot. You can't expect your customer continue to do that. You have to find ways to take those products to the blue dot generation. And so that's like, we have to do that. We have to get there. That's the future. So now we need to build relationships and figure out how to get it done.
All right, Andy, that's some serious philosophy and optimism. You're going to have to follow that.
Yeah, that's a tough one to follow. I'm going to be a little bit drier just because I'm a chief risk officer. I can't help myself. I was thinking about, as I think about this question, my message out to banks and fintechs is to recognize, and we kind of touched on this earlier, but the board and senior management, they need to understand that you've got to build, these processes and controls that are commensurate with a much larger institution. You've got to do this before, not after the fact. This takes, you got to hire the right experience. You got to hire the people with big bank experience. You got to get them in there so they can lead the organization. That to me is still, it's hard for community banks, smaller banks to digest. But I'm telling you, my examiners have point blank told me they're regulating me at a mid to large regional size bank. And yet I'm just a community bank in Everett, Washington. So that's kind of my key takeaway.
That's really interesting. I would say a sobering takeaway, but really, really important. All right. I don't know, Jeremy, if you were just punting or you've got something, but it's tough to follow.
I started out very optimistic. I'll just add a slightly pessimistic note to my overall optimism, which is I do think that if Andy is right that the federal scrutiny is not going to change all that dramatically with the new administration, and it's still going to be the granular nitty gritty concerns, and you still have to meet the same standards. I do think we're going to see a change in the state level. I do think that the state AGs, the state financial services regulators, as they did under the last Trump administration, will try to pick up the slack that they perceive the federal agencies not taking up. And I think that makes it only more difficult because the different state agencies and AGs have each has their own view of what is required, and they don't always respect the fact that the prudential regulators have been doing this for a long time and know how to do it, and it's a nuanced process. And so it's going to be, I think, in some ways more challenging, because at a time when we need standardization and we need to get on the same page as to what needs to be done, there are going to be a lot of different regulators with different ideas about what's required. So I do worry a little bit about that.
So thank you for tempering your initial optimism with a dose of realism. And I think with that, we've reached the end of the hour, but I want to very much thank Steve, Andy, and Meghan for a really great discussion, and AFC for hosting this. It was really great to talk to you and hope it was informative.